Hello everyone, and welcome to a new episode of Geopolitics and Money, where we will discuss the latest analysis of Zoltan Pozsar, credit analyst at Credit Suisse. Let's dive right in. In his analysis titled War on Commodity Encumbrance, Zoltan Pozsar examines the concept of using commodities, such as oil or gold, as collateral in financial transactions and its potential impact on international relations. One key focus of the analysis is the special relationship between China and Russia, as both countries are heavily reliant on commodity exports and have expressed a desire to challenge the dominance of the US dollar in the global financial system. According to Pozsar, both President Xi Jinping of China and President Vladimir Putin of Russia envision a future in which the use of commodities as collateral will play a larger role in international finance. To achieve this, they are working towards the development of new financial instruments and infrastructure, such as commodity-backed loans and commodity exchanges, which would facilitate the use of commodities as a means of payment. This return to the use of commodities as a form of currency could have significant implications for the global financial system. For one, it could lead to increased volatility in commodity prices as demand for certain commodities as a means of payment increases. Additionally, it could challenge the dominance of the US dollar as the primary reserve currency, as countries increasingly turn to commodities as an alternative means of exchange and store of value. In addition to discussing the China-Russia relationship, Pozsar also touches on President Xi's recent visit to Saudi Arabia. During this visit, he delivered a speech at the China GCC summit, in which he emphasized the importance of deepening economic and trade ties between China and the Gulf Cooperation Council (GCC) countries. President Xi called for the expansion of cooperation in various areas, including energy, infrastructure, and finance. This visit to Saudi Arabia is significant because it highlights China's growing economic influence in the Middle East, as well as its efforts to establish itself as a key player in the region's energy market. China is already the world's largest importer of oil, and its increasing reliance on energy imports has led it to seek out new sources of supply and secure long-term contracts with oil-producing countries. By strengthening its economic ties with the GCC countries, China is positioning itself to be a major player in the Middle East's energy market and potentially challenge the dominance of the US in the region. Pozsar's analysis suggests that the increasing use of commodities as collateral in financial transactions, particularly by China and Russia, could mark the end of the so-called petrodollar system. Under this system, oil-producing countries agree to sell their oil exclusively in US dollars, which has helped to maintain the dollar's status as the primary reserve currency. However, as China and Russia work towards the development of new financial instruments and infrastructure to facilitate the use of commodities as a means of payment, there is a possibility that the dollar's dominance could be challenged. According to Pozsar, this shift could also mark the beginning of the petro-yuan, with China potentially replacing the US as the dominant player in the global energy market. The recent visit by President Xi to Saudi Arabia and the expansion of economic ties between China and the GCC countries could be seen as evidence of this trend. China has more to offer to Saudi Arabia in terms of economic cooperation and investment, and the GCC countries may be more inclined to accept yuan-denominated payments for oil in order to strengthen their economic ties with China. If this shift towards the use of the yuan as a dominant currency in the global energy market does indeed occur, it would have far-reaching implications for the international financial system. It could lead to a reduction in the demand and value for the US dollar, while at the same time increasing the demand for and value of the yuan. It could also lead to a greater role for China in shaping global economic policies and decisions. One key development in this regard is the fact that it has been possible to trade oil contracts in yuan since 2017. This means that countries can agree to sell oil to China in exchange for yuan-denominated payments, rather than using US dollars. This trend is likely to continue as China is expected to enter into agreements with more countries to pay in yuan for their oil exports. In addition to this, China has already been buying oil from countries that are facing Western sanctions, such as Iran and Venezuela. By doing so, China is able to bypass these sanctions and continue importing oil from these countries, while also providing them with a source of foreign currency. This further demonstrates China's growing influence in the global energy market and its ability to challenge the dominance of the US in this regard. The trend towards the use of the yuan as a dominant currency in the global energy market could have significant consequences for the Western world, particularly the United States. One of the main reasons for this is the fact that China has good relations with two of the largest oil producers within the OPEC Plus cartel, Russia and Saudi Arabia. If these countries were to accept yuan-denominated payments for their oil exports, it could lead to a reduction in demand for US dollars and potentially decrease the value of the dollar. This would have negative consequences for the US, as a weaker dollar would make exports more expensive and imports cheaper, potentially leading to a trade deficit. Additionally, a shift towards the use of the yuan as a dominant currency in the global energy market could lead to a greater role for China in shaping global economic policies and decisions. China is already the world's largest importer of oil, and as it continues to expand its economic ties with oil-producing countries, it will have increasing influence in the global energy market. This could potentially lead to a shift in the balance of power away from the Western world and towards China. Pazner has also predicted that interest rates and thus inflation will remain high in the United States and possibly Europe in the coming years. This is due to the fact that the U.S. Federal Reserve has been keeping interest rates at low levels in order to stimulate economic growth in the wake of the COVID-19 pandemic. However, as the economy recovers and inflationary pressures build, the Federal Reserve may be forced to raise interest rates in order to keep inflation in check. If interest rates do indeed rise in the coming years, it could have negative consequences for the U.S. economy. Higher interest rates could lead to a decrease in borrowing and investment, as the cost of borrowing becomes more expensive. This could potentially lead to a slowdown in economic growth and make it more difficult for businesses and individuals to access credit. Additionally, higher interest rates could also lead to a decrease in the value of the dollar, as investors flock to safer assets that offer higher returns. Overall, Pazner's analysis raises important questions about the future of the international financial system and the potential challenges to the dominance of the US dollar. While it remains to be seen whether the trend towards the use of commodities as collateral and the rise of the petro-yuan will indeed occur, it is clear that these developments are worth paying close attention to in the coming years. Subscribe to this channel to stay up to date about these developments. Thank you, and until the next one.